In this video, our focus will shift to mortgage loans. Why mortgage loans? Well, they are the building block for the most common ABS, asset-backed security, namely MBS's, mortgage-backed securities, be they residential, so that's backed on a pool of residential loans, or commercial, indeed, loans for commercial type property. A mortgage loan is, of course, a loan secured on a specific item of property. So let me write this down. Mortgage loan is basically a loan secured on a specific property, specific item of property, and the lender, so you can think of the lender as, I guess, the bank, has first line. We talked about lines, first line loans, or first mortgage loans, or indeed bonds. That means you are the first person, the first entity to receive or to have a claim on the proceeds from the sale of that property if the borrower is bankrupt or goes into default. So the lender effectively has the right to seize the property if the borrower defaults, or in case the borrower enters default. If borrower defaults on their payment obligation, and the seizing of property will typically be referred to as its foreclosure. That's a foreclosure. That's a term which is quite relevant and good to know. So the lender forecloses on the property, they seize the property, and subsequently have the right to sell it and use the proceeds from the sale to settle the obligation, settle the borrower's obligation. And later on, towards the end of this video, we'll have a look at what happens when the proceeds from the sale of that property are actually not enough to pay off the obligation. Right. In this, let's say, section, you may be asked to do just a few very sort of light touch computations. First of all, it may come about that you'll have to calculate the monthly mortgage loan payments, and we'll do that together in a moment via an exam style question. Now, for that, we will use the time value of money worksheet. Another thing that your book kind of showcases in examples is the computation of what we call LTV. That's loan to value. This is basically the relationship between how much mortgage loan the borrower receives or has in relation to the value of the property which is acting as the collateral on the loan. And typically what lenders do is they provide a loan which is for less than 100% of the property value, meaning some of the purchase price needs to be provided by or put in by the borrower, by the buyer themselves. This is known as the down payment. So this relationship at the beginning of a loan is due to the down payment. That's the amount of money put in by the borrower out of their own funds. And we also call this borrower's equity, so what they put into the purchase transaction. And, the lower the LTV is, that means borrower's equity is higher, the more they have provided and the less the bank has kind of lent to them. Now, this is thought to be good in terms of a credit risk mitigation or default risk mitigation device, because there is, if the borrower has put more equity into the purchase, there is less likelihood that they will default, less likelihood of borrower default. The more they are with their own money engaged in the purchase, the less likely they will. It is that they will default. It's still possible. And what is more, if there is default, more protection for the lender in case property has to be liquidated, in case property is sold as a result of foreclosure, more protection for the lender. Right, because a higher property value or a property value is supporting less of a loan with more equity in the transaction. Right, so as I said, initially, the fact that we have an LTV that's lower than 100 typically is due to the down payment. So this is initially the case at the start of the transaction, but later things become a lot more complicated, because on the one hand, the loan is being repaid. So the L in LTV, the L term, should be going down, unless you have a loan that's denominated in a foreign currency that then, despite being repaid, the principal being repaid, it can still go all over the place. And or at the same time, you know, things are happening to the property value. So property value, that's the V term, could be either going up or down. This is difficult to sort of capture up front or decide up front. So it's difficult to say what will happen to the LTV, and sometimes, despite the loan being actually repaid, the principal of it being repaid, the depreciation or the drop in the value of the property is so big that we end up with mortgages that are so-called underwater mortgages, where the value of the loan is higher than the value of the house itself or the property itself, and we'll talk about that later on. Right. So, monthly mortgage loan payments is something you may need to calculate. LTV is something quite easy that you may need to calculate. And one more thing that I'll get you to calculate in just a moment is the DTI. This is the ratio of debt to income. So this is the debt to income ratio. It's very important in residential mortgage lending, and it basically is a measure of the borrower's ability or capacity to manage their monthly mortgage payments, monthly debt payments. And the way we compute it is very simple. We take the monthly debt payment on the loan and we relate that. We see how much, what relation that is to the borrower's monthly pre-tax gross income, and this is something you'll be given. Don't worry, you won't have to calculate somebody's gross income. That's not in the fixed income section of the curriculum, nor is it anywhere else. Just be careful, because they will often give you, as I will in just a moment, in an exam style question, they give you the income on an annualized basis. So the only thing you have to do is scale that down by 12. Right, here's the example. Given the following information about a fully amortizing level payment residual mortgage loan with 30% down payment. Okay, let's just quickly focus on these words. Fully amortizing means that once the last payment is made, once the last final monthly payment is made, the loan balance is zero. There isn't any big sort of balloon payment left at the end of the loan that still needs to be covered. Level payment means that we'll be paying an equal amount every month, and that's kind of the standard in these questions, if they appear at all. 30% down payment means that's how much equity the borrower will need to bring into the transaction. So borrower's equity, and we are told property value is 420,000. The annual interest rate is 6%, loan term 30 years, and the borrower's annual pre-tax gross income 160,000 euro. And the question is on the borrower's debt to income ratio. Right, in order to calculate the DTI, we need monthly debt payments and monthly pre-tax gross income. The denominator is easy to compute because we've got the annual pre-tax gross income. We need to think about the monthly debt payments. To be honest, in the questions that are in your curriculum, they typically provide you with this, but I think it's a good idea if you are able to calculate it. I see no reason why they shouldn't test you on this. So how will we get that monthly loan payment? Remember, it's an equal monthly amount. It's like an annuity. So it makes perfect sense to compute this using the time value of money worksheet on our calculators. Clear second FV, and now let's get the inputs. For N, you're going to have 30, because it was a 30-year, was supposed to be a 30-year loan, times 12, which will give us 360. 30 times 12 equals 360, make that the input for N. Now, for PV, you want the amount borrowed. So take 420,000, the house value, and multiply by 0.7 or 70%. That effectively 70% is our loan to value, how much loan the borrower takes in relation to the value of the property. So 420,000 on the calculator times 0.7 equals, right, that will give whatever, 294,000, and I'm going to make this my PV. Now, I'm not going to worry, like with bonds, about making this negative. I don't need to. The thing to absolutely appreciate is that you need to make your FV 0. Now, if you leave it blank and you do nothing to FV and you've cleared the time value of money worksheet beforehand, that will be fine. I'm still going to do it 0 FV. I need to provide the calculator for an input with an input for I over Y, and that's going to be the interest rate on the loan, 6%, but scaled down to a monthly period, so 6 divided by 12, which should give half a percentage point, indeed, and make that my not my PMT, sorry, my I over Y, 0.5, and now I can ask my calculator just to compute CPT PMT, and if I do that, it should give me the monthly periodic payment. I see 1,763. Okay, I got that result before when I was preparing for this recording, so I'm sure it's fine. And now I'm going to turn this into a DTI. So DTI is the relationship of this, the monthly payment on the mortgage loan, related or divided by the borrower's pre-tax income. This is annual, so we need to still divide that by 12. 160,000 divided by 12. Let's see what we get. 1763 divided by, I'll open a bracket, 160,000 scaled by 12, close bracket, equals, okay, more or less 13.2%. Let's check if there is an answer that complies with this result. Indeed, it is answer A. So, very easy stuff. If you get this, don't be afraid. Just compute it in a very sort of straightforward way. Nothing sophisticated about it. Right, some additional points on MBSs and mortgage loans, to be honest, as well. First of all, something that is very specific to the US. So it's a US-based distinction, but one which you need to know about. In America, mortgages or loans, and in particular mortgage loans, are split into the prime loan segment or prime mortgage loan segment and so-called subprime loans or subprime mortgage loans. Prime loans are those that are given or made to high quality borrowers or borrowers with a high credit quality, made to borrowers with high levels of credit quality. So these are borrowers who will have a strong employment record, a good credit history of repaying their debt. They will have lots of equity to bring into the transaction, so low LTV values, and also low DTI, low levels of debt to income, lots of income, and the debt payment isn't so big in relation to their monthly income. And those will be also the borrowers. So let me write down a few of these features: low DTI, low loan to value ratios, and also they will be offering first lie-in on the properties. On the other hand, you've got the subprime loans. These are obviously made to the less so lower quality borrowers, made to lower quality borrowers, and you'll definitely see higher DTIs, higher LTVs, and often these loans will be secured by, for example, second line. So the lender is not the first one to receive, whose claims will be satisfied from the sale of a property. Such loans are nevertheless made. They're called subprime loans. Now, in some countries, the residential mortgage-backed securities markets. We'll be talking about residential mortgage-backed securities in the next video, but effectively, when loans are packaged together and securities are created on the back of them and sold to investors, in some places, especially the US and I guess in Canada as well, they may come in different shapes and forms. Some are simply issued by private entities, typically banks, e.g. banks. However, there is a big segment of these which are issued and guaranteed by a federal agency, for example, or they are issued and guaranteed by what we call a GSE. That's a government sponsored entity. And a good example, not entity, enterprise, sorry. Enterprise, a good example of this is an institution in the US called Fannie Mae Enterprise, who issue mortgage-backed securities. Now, these two types, which are very specific to the United States and a couple of other countries, are what we call agency residential mortgage-backed securities. So the distinction realistically is between non-agency RMBSs and agency residential mortgage-backed security. So the reason why they are guaranteed by either a federal agency or a government-sponsored enterprise is that they are accordingly also issued by them. So issued by a federal agency in this case, and because a security is issued by, if it's issued and guaranteed by a federal agency, it's going to have what we call the full faith and credit of the government. So this carries the so-called full faith and credit of the government. This is something you'll find written in many of these prospectuses. If it's the US government, it means the US government is responsible ultimately that you as an investor get repaid on time in terms of principal and you receive your interest, even though the borrower or the borrowers whose mortgage loans have been used as backing for these securities may not be performing. In the second case, on the right-hand side, such instruments will be issued by the relevant government-sponsored enterprise, and they are not guaranteed by the government. Right, it's important to appreciate this. They are not guaranteed, by the government, but by the GSE itself. But by the GSE itself. Don't really need these parentheses here. Okay. Now, before the 2008 financial crisis, dubbed the subprime mortgage crisis, there were a lot of non-agency residential mortgage-backed securities around. However, following 2008, they to a large extent disappeared. They were often used in the context of subprime based RMBSs, and those have sort of rightly gone these days. They are no longer as popular as they used to be in the past. Right, some additional features of mortgage loans which I want you to be absolutely aware of. So, mortgage, so-called contingency features. This is what happens, sometimes. Well, first of all, the borrower, and this is something we mentioned in previous videos as well, the borrower has always an option to prepay their loan. That means they can make a principal repayment that exceeds what's scheduled. Effectively, they've got an early repayment option. It doesn't have to be a repayment in the full amount. It may be a partial sort of prepayment, but they can go and do something ahead of schedule. Now, from the point of view of the lender, this carries risk because it introduces an element of cash flow uncertainty. Cash flow uncertainty for the lender. So that equals risk. And, lenders try to protect themselves against this risk. So some of the ways to reduce the risk, for example, introduce a penalty for early repayment. And the design of that penalty is such that it's supposed to compensate the lender for the interest lost. Typically, what will happen is the borrower will choose to repay their loan early and finance the repayment using a fresh loan taken at a lower rate, and a penalty is supposed to kind of compensate the lender for the difference in interest rates, the original rate and the new rate in the market. So that's the element of interest lost if interest rates drop. Such penalties are definitely more popular in the US, more popular in Europe than they are in the US. And where I come from, for example, in Poland, they used to be very popular, prepayment penalties. Nowadays, lots of banks are offering loans without the prepayment penalty option, so things are changing as well. What did I write here? More popular in Europe. This doesn't really make sense. Not popular in the US, that's what I meant. In the US. Okay, and the second thing, second sort of contingency feature which I want to focus our attention on or draw your attention to is what happens if the borrower defaults on the mortgage loan. So if borrower defaults, on the mortgage loan, we know that the lender can sort of come in and foreclose. And what happens if the proceeds from the sale of the property are not enough to settle the debt? Yeah? You sell the property, but the proceeds are insufficient, not enough to settle the debt. Well, then there are two things that may happen, and everything depends on how the loan is structured. Because a loan may either be structured as a recourse loan or a non-recourse loan. In the case of the first type, the recourse loan, the lender still has a claim against the borrower for the difference, for the shortfall. Whatever has still not been repaid using the proceeds from the sale of the asset, the sale of the property, the lender can still chase the borrower for that. And this is the case, for example, in most European countries. However, we also have non-recourse loan where the lender, after the sale of the foreclosed asset, has no further claim against the borrower. So it's basically the lender's problem if the loan is not fully repaid using the proceeds from the asset sale. And let's just say that in the USA, things can be either this or this. It's actually a matter of state law and state regulation. Many states, however, do have this feature where their loans are non-recourse loans, and ultimately it's not the borrower's trouble or problem if the asset's value has fallen and is not enough. Asset value has fallen and is not enough to cover the obligation. And a term which I briefly introduced before, so-called underwater mortgages. So those loans where the LTV, is the loan to value, is actually higher than 100%, typically due to a big drop in the value of the property subsequent to the loan having been made, and typically the initial LTV was high anyway, and the value of the property acting as collateral has dropped. What happens if you've got an underwater mortgage? Well, if the mortgage loan is structured as a non-recourse loan, then often the borrower will have an incentive, or has an incentive, to basically just walk away from the loan, to strategically default on the obligation. Even if they are able to actually continue making the payments, they kind of go to themselves, right, I've got a loan whose amount overall value is higher than the value of the house, it's a non-recourse loan, so I'm just going to stop paying it. I'll default on the loan. The house will be seized by the bank, but it's not my problem really that the bank cannot sell the asset for a value, for a price that's enough to cover the loan obligation. You know, that's called strategic default, and be aware of that term. Please also appreciate that there are some negative side consequences of this, because if you strategically default, even though you were able to make the payments, you will tarnish your credit history, your credit score will drop, this will appear on your records, and you'll have a reduced ability to borrow in the future. You know, but taking that into account, some borrowers still decide to strategically default. It only makes sense in the case of non-recourse loans, because if you were to do this with recourse loans, the bank would still chase you for the difference.